Good evening, everybody. Yeah, hope everybody's having a good evening. Not not quite as exciting as the last couple of nights. No missiles seem to be going off. So tonight we're going to kind of delve into an area that people kind of shy away from, and that's trading trading the gaps. And the reason that most people shy away from it is because they don't or they haven't taken a full analysis and get a full comprehension of what a gap kind of represents. So as we're going through candlestick analysis, what we're looking for is obviously the high profit, high percentage setups. Now, if you go back to the basics, the 12 major signals all represent something that is occurring in investor sentiment. Now, out of the 50 or 60 candlestick reversal signals, the 12 major signals are really all you need to know because they're the ones that occur probably 99.9% of the time. The rest are just kind of fillers. You want to know them, but you don't need to learn them extensively. If you learn the 12 major signals and understand what the psychology was that created those signals, then when you apply gaps to it, you get a full understanding of what's actually happening. So, rhetorical question, what are the signals and patterns looking for? We're looking for the most powerful, high profit, high percentage setups. So, trading gaps, which is what the Japanese rice traders call a window, it basically illustrates where there's excessive investor sentiment, either in a bullish direction or a bearish direction. So if you apply that rationale to kind of the four basic gaps, and you understand what human nature normally does, now you've got a much more mental preparedness for identifying what you should be doing at, or not only what you should be doing, but which trades you should probably be going after. So as I often mention, in an upward trending market, all boats are going to rise in a rising tide. What we're looking for is those boats that are going to move a lot faster. So you got four basic gaps. You've got the gap up at the top. Now remember what the Japanese rice traders tell us. Where do most people buy? They buy exuberantly at the top. I always warn people that if you see a gap up in the oversold area, the overbought area, get ready to start taking profits. If you see a candlestick signal telling you there's indecision or there's a change of investor sentiment and they gap it down, that's a pretty good message that they want to be out of that trade or out of that trend with great force. You got the gap up from the bottom signal telling you the bulls are stepping in with great enthusiasm. Or you've got the gap down, again, going to that philosophy where most people sell, they panic sell at the bottom. So two of these gaps show force. If you see a candlestick buy signal in the oversold area and they gap it up, that tells you there's a brand new powerful force coming into that reversal trend. Or if you see that signal at the top and they gap it down, it tells you they're trying to get out of that position with great enthusiasm. The other two show exhaustion. That gap up in the overbought area, tell you that's kind of the final hurrah. That's where all the enthusiastic buying is occurring. Get ready to start taking profits. If they gap it down in the oversold area, again, that's where you're looking for the panic sellers. Everybody always asks, where do you grab for the fallen knife? Using candlestick signals and patterns and the gaps, you get a pretty good indication of where that fallen knife should be grabbed. You get little fuzzy sounds. All right. Okay. So let's just look at the logic. If we know an indecisive trade or a trading signal, the Doji, represents a change of investor sentiment, and we know the simple rules that the Japanese rice traders apply to those signals. If you see a doji at the top, get ready to sell. If you see a doji at the bottom, you need bullish confirmation to tell you there's been a change of investor sentiment, or the Japanese rice traders tell us the weight of the market could continue to push that market down. You always pay heed when you see a doji because it tells you there's indecision going on between the bulls and the bears. But here's the big one that we make tons of money from. The trend will usually move in the direction of how they open it after a doji. And it becomes more relevant when you see it occur in an extended area, like the overbought or oversold area. So anytime I see an uptrend, then I see them start gapping it up. Now there's a difference. We know what the doji tells you. There's indecision between the bulls and the bears. There's a difference between a gap up and them taking it solid up. This is a reversal signal or a potential reversal signal. If it opens lower the next day, we're taking profits. We're up here in the overbought area and they're starting to gap up. That should be your alert. That should be a warning to tell you to start looking for taking profits. And if they gap it up and right to a level that you can see where everybody else is watching, it becomes that much more relevant that that gap up may have been the last gasp, especially if it's an indecisive trading day. So on the other side of the coin, you see that indecision up there and they gap it down. That's a pretty good indication. That is where the bears have finally taken control. Now, here's what we're looking for in a bullish market. We're looking for that gap up from a signal in the oversold area. Now, remember, you can add a few more elements to make the probabilities of being in the right trade at the right time that much more feasible. A doji, gap up in the oversold area, and a close above the T-line. The probabilities become extremely strong that the bulls have taken control. A left-right combo, gap up in the oversold area, and right off a major moving average that everybody else is watching. This is what we call convergence analysis, which is what we're going to be doing, I guess in a couple weekends, the 24th or so. We're going to be walking through or doing a Saturday session on convergence analysis, which is merely applying as much information as we can to our visual analysis to improve the probabilities that we're in the right trade at the right time. Left-right combo, gap up above the T-line. This is our expected results. A series of dojis. When is it time to buy? When they gap it up out of that series of dojis. A morning star signal. A 3-day signal. Big down day, a day of indecision. The third day opens positive and closes more than halfway up that candle. But if you have the added evidence of bullish control, when they gap it up, that was your first alert to start buying. And then the fact that they took it well above the halfway point of that candle and closed it above the T-line, this puts you in a high probability trade situation. So anytime I see a signal, morning star, left-right combo, gap up, I should take a step backwards. Why won't most people want to go after that? Because they're hesitant about buying something that has gapped up, and boy, they don't want to be chasing something. This is the whole point of this demonstration. That if you see a signal that tells you there's probably a reversal in investor sentiment and they gap it up, you want to be buying because the probabilities are that's a new force starting. You don't have to be concerned about, oh boy, I'm chasing this. Now, a lot of people ask, well, can they gap up and sometimes trade back? Definitely. But the fact that you saw a buy signal in the first place and then maybe the next day profit taking still doesn't negate that signal unless they close it well down here. And that's part of that stop loss process. So if I see a gap up and it also tells me I've got a pattern setting up, like a J hook pattern, wave 1, wave 2, Morningstar signal, Doji gap up above the T line, what can I see occurring right here? A J hook pattern setup that tells me this wave right here should be the same magnitude as this wave right here. So visually knowing that this is a very strong reversal signal also gives me the what do I say, the implication that there's going to be a the next wave to a pattern that I recognize. Doji gap up, wave 1, wave 2, starting into wave 3. So again, this is not rocket science. If we know what the signal itself tells us that there's probably a reversal, that's why we're looking at them in the first place. And after that reversal, they're starting to gap up. That tells you not only has investor sentiment changed, but now they're coming in with great enthusiasm. So what do we want to see just as a confirmation of a bullish reversal signal? If they gap this up and start trading positive, what's it telling us about the change of investor sentiment? They're confirming it. It's time to be buying. Until the low of the bullish signal or pattern is taken out to the downside, is it not considered negated? Casey, I don't understand what you had. Until the low of the bullish signal. Yes. So if this is my bullish, well, not even the low. Well, the low intraday. So there's a very simple confirmation and stop loss rules from candlestick analysis. If this is the signal that told us the bulls were taking control, then where are the bears back in control? Well, if they can close more than halfway down the candle that told us the bulls were in control, the bears are still in control. Close out the trade. Now, this is a process, and I'll regress here a little bit, that candlestick analysis is a strong indicator when there's been a change of investor sentiment. We're looking for the setups that tell us the strongest investor sentiment. But it also tells us when that reversal signal did not confirm. So if I bought here and it traded up and then came back and closed down here, remember you're always told to cut your losses short and let your profits run, but nobody ever tells you how to do it. Very simple logic. But if this doesn't confirm the bullish signal and closes more than halfway down that candle, close it out and move on to something else. Now, if you were like me in the old days, if I bought something because I thought it should be going up, and it went up and then closed more than halfway down this candle, what was my first thought? Oh man, I thought this should be going up. I mean, I'm going to give it a little bit more time to see. Instead of saying, this didn't work, I'm waiting or hoping that it will turn around and go back up like I thought it would. Let the market tell you what the market is doing. If you close out the bad positions quickly, that gives you more time to go find good trades that are heading up. Anytime I see a signal, I'm looking for bullish confirmation. Bullish confirmation is positive trading the next day. Gapping up. This one is a wee little teeny gap up. And where did it come from? Oversold condition and right smack dab off the 50 up through the T line. Just high probability reversal results. Little hammer type signal, gap up. So what's the result? Now you analyze what your trend is doing based upon your T line and everything else that you use. So if I also see a gap down in the oversold area, what do I start doing? I start watching for a reversal. Again, convergence analysis. Downtrend, downtrend, downtrend. But notice what's happening here. Look how far away we've gotten away from the T line in the oversold area. The T line is the 8 exponential moving average. I'm glad you asked that, Bob, because I forgot to define that. Very simple. We call it the T line because it's the trigger line. We were trying to figure out some fast name for it, and we came up with a T line. There's a very simple concept with candlestick analysis, the signals and the T line. The candlestick signals are the graphic depiction of what's going on in investor sentiment. They're very accurate because the Japanese rice traders have shown us the results of not what they have researched, but what they've actually used over the last 400 years. Now, you always have to come back to what time frame do you use for gaps. Jenka, usually you have to do it on the daily because on an intraday basis, you're not going to get gaps because everything's kind of flowing. So it's anything that you have where there's buying and selling and a time frame gap from buying and selling. Now I forgot where it was. Oh. So the further I move away from the T line and I see them, notice how they closed here and they gapped down even below the previous day's low and did another hammer signal. That tells me start watching for a buy signal. It depends, Nasa, it depends on where you are. If you're right on the T line in the overbought area, yeah, you might close it as it comes down. And that's also going to be a function of if I'm up here and I'm going to hold on to this as long as it doesn't close below the T line, and then all of a sudden we see the market start selling off and this is selling off, yeah, I'll probably close it. Can you go over a gap up with an inverted hammer? Yeah, if I can find one. I don't know. I may have eliminated them. But that's easy to, I'll see if I can find one. The hanging man. Hanging man, what do you do? If it trades lower the next day, you close out the position. Probably a downtrend. A hanging man followed by a gap down the next day, more compelling, you're going to be in a downtrend. So that gap, as small as it may be, is telling you they're trying to get out of this position with great enthusiasm. So you got two things. Either if you're long, you're out immediately. If you're thinking of going short, you start watching to short that position. There's your inverted hammer in the oversold area. Now, the inverted hammer is one of the 12 major signals. It's probably the least frequent of the 12 major signals. But it's got probably the highest probability as far as producing results. And there's nothing official on that other than my experience of trading them for the last 40 years, somewhere around that. That anytime you see an inverted hammer and they open up positive, your probabilities of the trade going positive from there is probably 95% or even greater. So anytime I see an inverted hammer, I'm watching to see what it does the next day. Because if it starts trading positive, I know I've got a a good trade. And then your kicker signal has the gap built into it. What if the inverted hammer comes on a gap up day? What if the inverted hammer comes on a gap up day? It's not an inverted hammer. It's just a day. Let me. Yes, Doug, these are daily charts. Now, obviously, gaps aren't going to occur on intraday charts because everything's flowing from 1 minute to the next or one trade to the next. So what you use it for is analyzing what might be the overall trend of whatever you're trading. So Don, if this, let's say hypothetically, this opened here, came up here, and closed down here as an inverted hammer, well, that wouldn't be an inverted hammer signal, because where does an inverted hammer signal need to occur? In the oversold area. That would just be a formation during the day. Yeah, these are the metastock charts, and I've changed them over the years. But obviously, a red candle is where it opens here and closes here. A white candle is where it opens here and closes above where it opens. A red solid candle. Now, a green candle is where it opened and closed below where it opened, but it was positive for the day. For example, here's another one. It opened up here and closed here, so it should be a red candle. So I've had them take that off, or you can even own charts where they're just red or white candles. Okay, so the kicker signal is the gap already built into the signal. Notice it opened here, closed here. Next day they gapped at or above the previous day's open and went the opposite direction. That essentially tells us they've gapped or they've kicked the investor sentiment in the opposite direction. So anytime I see that kicker signal, I'm probably buying immediately because it tells you there's been a drastic change of investor sentiment. And then here's another one that's called the bullish flutter kicker. The alert or the message, the information was it opened here and closed here. The next day they gapped it up and did a doji. Now that doesn't look real compelling. However, what do we know about the doji rule? We know that if it opens positive, it's likely going to trade positive. So even if we've missed this because it didn't do very much, and we found it on our scans the night before, all we have to do is say, all right, I'm going to watch this. If it opens positive tomorrow, I can be buying immediately. Now, that does two things for you. It gives you a high probability situation, obviously, but a lot of times if I see a kicker signal, I might not have funds available because I've fully invested. I've got to go say, oh man, what do I have that I might sell? And I've got to figure out how to get those funds so I can move it over to this trade. On this one, when it closed here, and that night I'm looking at things, I can have a lot more time. Where's my stop loss here? Probably back at the doji. Or maybe at the open. If I was buying here and it went all the way up here and then came back down through the open, what did that tell me about my signal? It disappeared. I want to close it out. It didn't work. Now, for every time that might happen, you probably got 30 trades that did work. So the gap is essentially telling you that there's great enthusiasm coming into that trade. And when we can see that after a candlestick signal, it just puts us in a situation where it's not only putting us in a signal confirmation, but a pattern confirmation. If this is our fry pan bottom and they gap it up through the beginning of the fry pan bottom, number one, and number two, the 200-day moving average, which could be perceived as a resistance level, what's it pretty much telling us? That everybody and their brother could see that this was a resistance level. We could see that it was right at the breakout of a fry pan bottom. They had no more regard for the resistance level. That's telling us that we have a fry pan bottom breaking out. Would you be a buyer after a positive open, even though you're below the T line on the previous chart? Yes. Yes. Remember, we're not buying the T line. We're buying the signal or pattern. Now I'm trying to see if that's the T line. I guess that's the T line. Yeah. So if you cut the chart off right here and you had a gap up in the oversold area, Doji, and it opened positive, where do you think your logical first target is going to be? Probably back up to the T line. The white candle is a bullish candle. The red candle is where it opens here and closes below where it opens. The white candle opens here and closes above where it opens. Now, this should be a red candle because it opened up here and closed just lower. But the reason they made this a green candle is even though it opened and traded below or closed below where it opened, it was above it was a positive trade that day. So I should probably get rid of these. Since that time, I've eliminated the green and just made that a red candle. Can the same be traded on a 10-minute chart? Kicker, but below the T line? Yes. But very rarely are you going to get a kicker on the 10-minute chart on something unless something drastic happened, like an announcement. Because on a 10-minute chart, it's all going to be flowing. Oh, boy, I don't know. Oh, where would I have exited? Probably somewhere in here. Because it looked like it was trying to do a J-hook pattern, and then it failed. So at this point, with stochastics in the overbought area, and you can see it wasn't moving up very much, you close it out. Now, what's the worst case scenario? You put a buy stop back up here because if it comes up this way, you got wave one, wave two, wave three. Right now, if you cut the chart off right here, you don't know whether it's going this way, or this way. So why risk it? Because if you've got money that's in an iffy situation, meaning you don't know which way it's going to go, close it out, take your profits, and go find a chart that looks like this. That's the benefit of the scanning techniques for candlestick analysis. On any given day, I've got probably 5, 10, 20, 25 good chart setups. Now, that's why I tell people learn how to scan for the best charts. I think we did a scanning session not too long ago. But the reason is when I do my scanning and I sort them to where I cultivate it down to the best 2 or 3 trades for the next day, that doesn't mean I eliminate all the others. The others were just good. I happened to pick out the ones that I thought were the best. Well, now if they don't open correctly, now I can go back to some of the others to see whether they're opening correctly. All right, forgot where we were. Oh, so, oh, Shazam, what's that? I got to figure out how to get the spam from popping over on this screen. So anyways, here's confirmation. What do we expect coming out of a fry pan bottom? That's what I say. Um, there's a big gap up or a enthusiasm breaking out. Same scenario on a dumpling top. See the rounding top and then the doji gap down. That tells you that selling pressure has now become very evident. If I can see a pattern setting up, a J-hook pattern, where do I expect my resistance level to be? Obviously right here. Got a doji or a hammer, doji, bullish confirmation. What that tells us about the T-line? They haven't been able to close below the T-line. Then the next day they gap it up at the resistance level. What that tell you immediately about the resistance level? It's not there anymore. They're buying and they're confirming what pattern we expect, the J-hook pattern. Wave 1, we're buying right here, anticipating wave 3 being the same as wave 1. So this is not rocket science. If you use candlestick signals and apply it to your the patterns and the signal reversals, that gap up is a quick illustration that there is great enthusiasm coming into that trade. All right, so that's candlestick signals and gaps. I'm going to go to live charts now, except there's an online traders session going on January 11th. Ooh. Becky, do we have a link for that? Okay. Yeah, so it's MetaStock. So that is, what, Saturday? And I'm going to be doing the breakout session, showing you which trades are the best as far as breakouts. Okay, now let's go to some live charts to show what we're looking for in today's tradings or today's markets. See if I can do this. All right, let's take a quick look at what, just generally what the Dow. The reason I want to show this is there is a lot of consternation out there that the market is frothy and exuberant buying coming in. Except there isn't any exuberant buying. You can see how in this uptrend, there's been backing and filling, there's been profit taking. It hasn't been a straight up market. Now it's getting near the top of the channel, but it's not telling us there's any major selling going on. But this uptrend is in progress. And if you look at the longer term chart, bah humbug. And this has been going on for a few months now. So what keeps us in this market? Well, without candlesticks and the T-line, oops. Somebody was asking about the T-line. Again, the 8 exponential moving average. The other moving averages are the 200 and the 50 simple moving average. Now, the reason we have those on our charts is not because we're trading off the 50 or the 200. It's because every major money manager around the world usually uses those to make their decisions. What about the gap ups today and a week ago? We're going to get to those. My stochastics, I've got at 12.33. I'm a swing trader, so most of my trades outlast anywhere from 2 to 10 trading days on average. Now, in an upward trend like this, maybe they last 30 days. Could that be an exhaustion gap? Where is that, Gerald? Today? No, not really, because it didn't really gap up above yesterday's high. Now, and I'll get to maybe, yeah, I'll get to some that look like they could be exhaustion gaps. So here's the market trend on the Dow. Now here's the market trend. I'm going to make this a little bit bigger. On the NASDAQ. So let's say if you kind of do this, you can see what the top of the trend channel looks like. Today they gapped it up. Bigger again. So they kind of gapped it up, not real excessive, but they kind of gapped it right up here to the resistance level. So that gives us a couple opportunities to figure out what to do at this point. So you got a Doji in the overbought area. You're still trading above the T line. Not only trading above the T line, this is what we call the 3T line. It's a 3 exponential moving average, which gets a little bit more refined if you start moving away from the T line. But just a simple observation is that if they can't even trade back below the 3T line, obviously they're still up above the T line, which tells you there's still lots of good buying going on. So this is to say that we're in a trend. We're still above the T line. It might see some profit taking. However, as long as the markets stay above the T line, we know we're in an uptrend. Now, does that mean we're in trouble with long positions? Definitely not. We've still got plenty of good bullish charts that are going to be moving up as long as there isn't any major change of the overall market trend. So this is something I want to make obvious to everybody, if I can. And they make this a little bit small. Now that might be exhaustion. But here's the other thing that you want to observe. Look where this big strong price move started when they gapped up out of this slow curve range. So this is what I'm trying to illustrate here is when they start gapping it up out of the oversold area, that's when things start getting much more active. There's a completely different view of this stock. Notice over here, this one we've just made lots of good money because of the fry pan bottom, took profits, got back in with a new set of calls, obviously making some very good profits on this one. But you can see where the new activity started on this one. It was going sideways, and then when they started gapping it up through resistance levels, that's when you start having the opportunity to trade price moves that you're not just sitting there waiting to see what happens. Calla, gap up. That's when things started getting much more active. APTO, gap up, your best friend signal. Now it looks like it's going into a J-hook pattern. TGTX. There's your kicker signal. Breakout. Still in an uptrend. So the reason I'm pointing these out is that when you do see those gap ups, that tells you there's a whole new investor sentiment coming into the trading of these. And that's where you want to be. If you understand what happens after candlestick signals or how to use the candlestick signals and patterns, you want something that's going to make you money, not sitting just kind of in a slow, stodgy type trade situation. So today, this one, AGTC, gapped up. Now observe the obvious. For months, that may have been even longer than that, it traded flat. Then something happened. We don't have to know what happened. All we have to know is that there's new activity in this one. So what I'm trying to illustrate here is when they gap up, especially doing best friend type signals at the Doji gap up, that means there's new enthusiasm uh, in that price move. And now you can calculate what to do based upon knowing that there's a lot of activity or a lot of interest. So if I was looking at this one, you can see what happened. They took it way up, brought it back down, profit taking. We know the simple rule that if it opens positive tomorrow, the profit taking's over. You can still be buying this one because of the best friend signal. Avis, look how it broke out with a gap up through that level. That tells us there's probably a new wave. So the gaps pretty much indicate when there's new strong interest coming in. Notice Natty broke through this downtrending channel with your best friend signal. These are the type of trade setups that you can go after with much more enthusiasm because there's going to be a lot more activity in here. Kind of an inverted hammer. Gap up. What do you think this is going to do? Probably come back up to the top of the channel. Let me make sure. If you've got a resistance level and they gap up through that resistance level, confirming there's a fry pan bottom breakout. Yes, this is being recorded. What is a best friend? A best friend is a doji followed by a gap up. I'll probably have some more here. Let me remember what a doji represents. Doji represents indecision. Then when they gap it up, that tells you what their decision is. And that doji gap up usually illustrates or preludes a very strong price move. Railroad. So CDK today did a doji gap up. Your best friend. What do you think this is going to do? This is going to continue higher. So any given day that I do my scans, the first things I'm finding are the ones that have gapped up. You can see what this one did. A little gap up, but look where it gapped up, kind of right through that resistance level. That kind of a rounding bottom. What do you think is going to happen here? There's new enthusiasm in this one. Nah. We looked at CGC today. There's still nothing of any great consequence there. I probably wouldn't pay attention to this one until it breaks out to this level. And the reason I wouldn't pay attention to it is, and there's too many good ones out there right now. So kind of your gap up, where? Right through that resistance level. What's that tell us? Probably more upside. So here is a potential exhaustion. This is Apple. In the options room, we've been after Apple ever since it broke out through this level. Because what do you have? Wave 1, wave 2, wave 3. How long do you hang on to wave 3? Until you see a sell signal and a close below the T line. Except, are there good recordings of different patterns like the fry pan bottom? Jake, yes. On our website, we've got training on the signals, the patterns, entry and exit strategies, scanning techniques, stop losses, when to start taking profits. Everything that is built into our trainings is based upon common sense. And that's the major aspect of candlestick signals. All it is common sense put into a graphic depiction. If you go back through and try to remember all the sage advice you get from investors of what to do and what not to do, it's all built right into the signals. And the way I learned and became convinced about candlesticks a few decades ago was that every time I saw something and I said, yeah, that makes sense. So it wasn't like I was having to learn things that were formulated or that you had to interpret. It was just common sense. Now, let me see if I can make this smaller. Try to see if wave 1 and wave 3 is getting pretty close to the same on Apple. And today, see what Apple did in the overbought area? They gapped up. So we got a very simple rule. Where do you think most people buy exuberantly? They buy exuberantly at the top. Where do you think is the best place to put your stop? At today's open. Because logic says if it opens positive and comes back down through that level, that gap up warning telling us exuberance has come in is now telling us be ready to stop out if you start seeing some selling. Western Digital, another one we recommended in the options room. Because look at it gapped up here and then did your best friend signal, Doji gap up. What it tell us? Wave 1, wave 2, now we're in wave 3. So what we can utilize the signals and gaps is to give us a high probability trading format to tell us what normally happens with human nature. Micron did the best friend signal the other day. Doji gap up. All right, that doesn't necessarily mean it's time to or doesn't necessarily mean we blindly hold on to this. We're having a little bit of trouble getting through this level. If this opened lower tomorrow, we'd probably close out the position and wait to see what it does back here at the T line. Didn't WDC it did, but not yeah, so if you were what do I say, nimble and it opened positive, you put your stop right here. So when it came down through that level, it stopped out. That would have kept you from holding on to something all the way down here. However, it gapped up and started drifting down in a day when the market was trading up big. Kind of held on to it, thinking, all right, probably not, probably just some profit taking. So if it had closed down here, you know, to say that they're selling it, let's close it out. So I wouldn't have stopped out necessarily when the market itself was trading up 150, 200 points on the day. I'll just kind of consider that some profit taking. All right, so some of the charts. There's your Doji sandwich on CRYS. Remember we recommended this a couple of days ago, or yesterday, I guess, anticipating to get through here. Well, now it went through here. What do you got going on? That's your bobble breakout. That's your J-hook pattern that you can be easily visualized by failing at the 200 and coming back up through that level. What do we expect now with a high degree of probability? Wave 3 being that same magnitude. We recommended COLL. Look at your little hammer kicker type signal, breakout. When they start gapping up, that tells you they're trying to get in this with great enthusiasm. And if they're gapping up through resistance levels, that means they don't have any regard anymore for resistance level. Halo is another one. This is almost kind of your bullish flutter kicker signal. But notice what it did when it gapped up. Broke this downtrend, gapped up above the T line, came off the 50. I would suspect a lot more upside on this one. QCOM was another one that we recommended because it did a little gap up off the 50. Let me make this big enough where we can see it. And now what do we got going on? There's our scoop pattern. And we would still be buying this one on positive trading tomorrow because what do we expect coming out of a scoop pattern? That slingshot effect to the upside. So here's one where it gapped up the other day. Not any breakout level, but they announced something. But the next day they opened it lower and closed down here. So it had a bearish harami. So what was our game plan at that point? If it opened lower, so it's probably coming back to the T line, close out the position and wait to see what it does at the T line. So you often hear me say it has to open positive and trade positive to stay in it. Well, fortunately, that's what it did. So this one, we started buying calls down here when it broke out. So this is the nice thing about utilizing the different indicators like the T-line, because that keeps us in this trade until we see it either moves too far away from the T-line, we start taking profits, or we see a sell signal and it starts moving back to the T-line. So that gap up in the overbought area, could be seen more over here in whiting. Notice that your stochastics are starting to roll over. They gapped it up and started bringing it back down. Where was a logical place to put a stop? Well, in this case, by this day, either it was still heading up, but it shouldn't come back to this level. So you just simply put a safety stop right there. Oops, I guess I did them all. Oh, a couple good looking charts to look at tomorrow. There's your J-hook pattern on iRobot. Now, why is this a compelling chart? Because we know what human nature normally does. If it comes up through a resistance level, notice it broke out with a Doji sandwich, and they start taking profits, where do you think they're coming back to? They're coming back to the resistance level to see if it's going to act as support. And if it does act as support, everybody that's watching this, what do they know about this? What happened here? They saw it support at the 50. They're buying. And notice what the nature of the signals were at the 50. A hammer, a doji, a hammer doji, then bullish confirmation, kind of your cradle pattern. What do you expect your next price move to be? Wave 1, wave 3. So I can pretty much calculate this. If it started at 42.50, went to 52.50, 10 points, that means we could probably head up toward the $60 range. Overstock, another chart that told you when they came up to the, they broke this downtrend with a left-right combo. They failed at the 50. They pulled back, in this case, to the 34 and started coming back up through the 50. What'd that tell you? They weren't selling it off. You get ready to buy this one. So would you buy iRobot at the close today, or would you try to get it down closer to the T-line? No. I wouldn't have bought it on the close today, because first of all, maybe I didn't even discover it until I did my scans. And two, I don't want to see it. That's one thing that I hear so many people say, I'm going to wait for it to pull back so I can get in at a better price. Now think of that concept. You're looking at something that is showing strength, that you want to be buying because it's showing bullish sentiment. But you're waiting for it to come back. The seller's in control, so you can buy it. That's called the immaculate execution. That you wait for it to pull back because we're so brilliant that when it pulls back, as soon as we decide to buy it, it's going to turn right around and go back up. That's wishful thinking. I'm looking for what the signals and patterns are telling me. The bulls have taken control. So what do I want to do now? If this opens positive and starts trading positive, I'm buying because that's telling me they're confirming. I'm not trying to buy at the absolute bottom. And I'm not trying to sell at the absolute top. I'm trying to get the fat part in between with a much higher degree of correct probabilities. If you get much higher correct trade ratio, but smaller profitability, that compounding effect is going to be much greater than trying to nail it at the bottom and nail it at the top. Oh, let's see. So we did overstock. Space. What type of pattern is this setting up? See our J-hook pattern. You can buy this one on positive trading tomorrow. And we did halo. So essentially what we're doing, identifying the signals, the patterns, and even going after the gap up situations, is we're identifying where the strength is coming into the new price move after a reversal signal. And that's exactly where we want to be. Snap could be a bullish flutter kicker signal setup. Yes. So what's your game plan on this? If it opens positive, you can be buying because now you've got that bullish flutter kicker. Bristol Myers has somewhat of a J-hook pattern, but more of a little scoop pattern, kind of a flat handle. And notice what happened today. There's your Doji sandwich. Bullish candle, Doji, opens positive. That candle right there is usually going to be the same magnitude as that candle right there. And what that tells us about our breakout area, that it was breaking out. If you are buying options on a J-hook pattern, would you go out of the money if that is where the volume is? You go based upon what your trading strategy is, John. Some people like to have less money involved by going out of the money. I'm usually looking at, if this is wave one, and I'm going to just try to figure this out. So let's say from 55 to 65, 10 points. And this is from here would take us up to maybe 75. Well, I've got a couple different strategies. If I want to buy something up here as far as a out of the money inexpensive call with the anticipation that it could go right through that level, that's one way to do it. If I'm more conservative, I'm buying the 65s. Or if I know that it could go to 70, let's say 75, way up here somewhere, maybe I come up here and I buy a 67 and sell a 71. 4 points. And let's say I'm paying 65 cents for that spread. That if that spread, or if that goes up above 71, my 65 cents now goes to $4. When would you use a credit spread? I usually use a credit spread when we're getting very close to expiration, meaning like within a week. So where are we right now? Oh, we are. But let's say this was Monday and it was expiring on Friday, 5 trading days away. Maybe I'm better off selling a put, or what did I say? Yeah, selling a put or selling a call, because that probably makes more sense as far as the percentage move doesn't have to go as far. Anyways, we will be doing a session. Oh, that's what I forgot to do. We're going to be doing a session pretty soon on spreads to show why they're much more beneficial. If I'm buying options, I would say probably 80% of the time, 75% of the time, I'm buying spreads because the leverage is much better, the risk reward factor is much better, and you have less money exposed to that trade to get a much bigger percent return. Okay, guess that's about all I got tonight. Oh, mercy sakes. Okay, I bought yesterday after it came up through the. Whoops. But I set it first, got stopped out by the end of the day. Of course, today it flew up. After reviewing what I did, I realized the shorter term chart, it was on its way down and below the T line when I bought it. Usually time doesn't permit me to watch the market closely. What would make sense? Would it make sense to use a 5-minute chart and get in when it was above the T line or something? That's what you need to sit down some night and do. Let's see. So here's what you have to analyze. If you stopped out, this is not an unusual situation. We have a big breakout move, consolidation, and then after the consolidation, the buyers come back in. So there's a lot of times where if I bought calls and it came back down here, it didn't do a sell signal, just consolidated, but I have my next trading rule. It has to open positive and trade positive the next day. If it opens lower, I close out the position. The reason for that is, what did this tell you right here? That there was probably a new strong bullish dynamic coming into this price move. This wasn't any signal telling you they were reversing, but give it one more day to see whether this information right here is confirming. It's up to 93. Okay. Tom, I don't want to do too much. I'll look at them. That's just a fry pan bottom. That if you're buying or if you're long, it needs to get up obviously through the moving average. And so here's another one where you can see where it's gotten to. Right here at the breakout area. And a doji. And what do we know about the simple doji rule? It's going to move in the direction how they open after a doji. So if I was long, I'd have a safety stop just below today's low, because if it comes down through there, what's it telling us about our doji? It's moving in this direction. RT, I think the Dow has already moved into wave 3. Make this small. This is why in our chat rooms or in the chat rooms that we do is we already saw wave 1 and wave 2. Now, if I make this smaller, somewhere in here, there was a resistance level. There. But you can see what was happening. Let me make this bigger again. Uh-oh. But you had a wave one. Oh, it was right here. When it broke out through this area on this fry pan bottom, that told us we were in a new wave to the upside. We're still in that wave 3 right now. And that, I would suspect, has still got a few weeks to go. But our important factor is that this wave is in progress, even on the shorter time frame. Wave 1, wave 2, wave 3. I wouldn't be surprised if there isn't some backing and filling. But as long as this trend stays above the T line, you can stay with it. The transportation index also is not doing anything that's showing us any bearishness. And notice how it's pulled back to the 50 and showed support. As long as this stays above the T line, we're still in an uptrend. Okay, so there's still lots of good trade setups out here. And this is, again, why knowing what the investor sentiment is based upon patterns, I would suspect that Luckin Coffee might have another big day. There's usually 3 big days. Oh, forgot this one. Skipped over. Notice what happened on this one. We recommended this one a few days ago because of the kicker signal. And notice the gap up from the kicker signal. What that tells us about our uptrend. We still had good prospects of a strong uptrend. All right, everybody. Thank you for showing up tonight. This is recorded. It should be sent out to everybody that registered. All right. Have a good evening. We will see you bright and early in the chat rooms. We'll see you then.